The housing market in California, long among the hottest and most expensive in the United States, is showing notable signs of strain. Inventory is climbing, buyer demand is softening, and high mortgage rates remain an affordability barrier. In California, many existing homeowners have low mortgage rates and are reluctant to sell and upsize, limiting supply for new buyers. Let's dive in and don't forget to subscribe. San Diego. San Diego has long been one of California's premium real estate markets. Beachfront appeal, strong lifestyle demand, and limited land supply combine to keep prices high. But for 2025, several warning signs are flashing. According to a recent national analysis, the San Diego Chula Vista Carlsbad Metro registered a median list price of about $948,500. Yet year-over-year list price change was minus 4.9%, and the share of price-reduced homes stood at 19.7%. Meanwhile, inventory growth and slower sales are contributing to weakening momentum. California as a whole has seen home listings and supply increasing. Beyond the raw numbers, San Diego faces structural challenges. High asking prices reduce buyer demand, mortgage rates remain elevated, and many homeowners with low existing rates are disincentivized to move, further inhibiting turnover. The result? Fewer transactions, longer days on market, and more sellers willing to concede price. According to news reporting, San Diego was one of the California metros listing home value declines, with a reported approximately 2% drop in median list price per square foot as of early 2025. Given all that, San Diego is a strong candidate for a price correction in 2025. The combination of high base valuations, reduced buyer pool, and growing supply tilt the risk downward. That said, the correction is likely to be gradual, not catastrophic. The broader market lacks the oversupply seen in past crashes. In summary, San Diego's premium price tag, plus current weakness in demand and rising inventory, sets it up as one of the California cities where we could see meaningful price pressure in 2025. San Francisco. San Francisco remains a marquee example of the cooling high-end coastal market. According to reporting, downtown condo prices dropped to levels unseen in a decade, while elsewhere in the city, new condo pricing still exceeded $1.2 million. More broadly, one Newsweek article notes, housing inventory in San Francisco is exploding, and warns of potentially sizable price drops in the second half of 2025 in Northern California. The Bay Area's challenges are accentuated by tech job volatility, remote work weakening premium urban core demand, and elevated costs of living, which push some households outwards. The region's economic ranking has also suffered. It dropped dramatically in the latest Milken Institute index because of housing cost and wage growth issues. These factors put San Francisco among the most vulnerable major markets in California. The high valuations, broadened supply, and weaker demand intersect here. While the core appeal of the region remains strong, in 2025 the risk of a price correction, rather than sustained rapid growth, is high. Buyers may get more bargaining power, sellers may face longer time on market and slim margins. In short, San Francisco is a standout city prepared for potential price softness. Oakland. Just across the bay from San Francisco, the city of Oakland shares many of the same dynamics. According to a Business Insider summary of data, Oakland saw the steepest year-over-year drop among U.S. major metros in the 4 weeks leading up to late July 2025. Down about minus 6.8% to a median sale price of approximately $850,000. The Bay Area's regional pressures, high cost of living, employment uncertainties, elevated mortgage rates, and an affordability crunch all apply in Oakland. As buyers pull back and as more listings come online, sellers may face weakened pricing power. Combined with the fact that many buyers may opt for cheaper adjacent markets or rentals, Oakland appears to be among the more acutely stressed submarkets. While high-income segments may hold up, the broader market is already seeing downward movement in prices and rising days on market. For 2025, Oakland is very much a city where price declines are already underway and could deepen as momentum shifts further toward buyers. San Jose. The San Jose, Sunnyvale, Santa Clara region sits at the very high end of the pricing scale in California. According to a recent report, the median list price in this metro was around $1,365,750, with year-over-year list price change about minus 4.6% and active listings rising approximately 12.5%. As with the Bay Area more generally, San Jose faces strong downward pressure from high absolute price levels, affordability limits, remote work shifts, reducing the premium for proximity to tech campuses, and rising inventory. Some analyses indicate that high-cost regions like the South Bay are leading the next phase of downward adjustment. Given those dynamics, San Jose presents a strong case for seeing meaningful pricing softness in 2025. The base valuations are very high, meaning any drop in buyer demand or increase in supply has amplified effect. While the region has strong fundamentals, tech jobs, innovation economy, the near-term risk of price correction is elevated. Los Angeles. The Los Angeles metropolitan area remains one of the largest and most expensive housing markets in the U.S. The most recent data show that the median listing home price in the city of Los Angeles, California, sat around $1.2 million in August 2025, and the median listing price per square foot was approximately $686. Homes on average sold after about 56 days on market, and the sale-to-list ratio was about 98.7%, i.e., homes on average sold slightly below the list price. Elsewhere, a broader data set for Los Angeles County shows a median home value of approximately $936,000 with a one-year change of negative 2.4%. Data through September 2025, according to Zillow. In addition, statewide affordability metrics highlight how expensive homes are in California. For example, a bottom-tier home in California in mid-2025 required annual income of about $145,000 to qualify for the mortgage, nearly 50% higher than the state median household income. Why 2025 looks risky? At median listing, prices around $1.2 million and median values above $900,000, many potential buyers, particularly first-time buyers or those with moderate incomes, are priced out. The affordability barrier is substantial. California's report shows monthly payments for a mid-tier home exceed $5,900 in June 2025, driven by home price increases and elevated mortgage rates. In Los Angeles, this means fewer buyers feel comfortable buying at scale, reducing competition and placing downward pressure on prices. Also, mortgage rates have remained relatively high in recent years, reducing monthly payment affordability even if home prices were flat. Existing homeowners with very low interest rates are less likely to move, limiting turnover, and thus supply may be constrained, but demand is also constrained. As the California Affordability Tracker notes, many new buyers face much higher payments than those who locked in earlier. More than that, reports indicate that the market in Los Angeles is shifting toward a more buyer-favorable dynamic. For example, a summary by ABC7 noted that in Los Angeles, sellers outnumber buyers by about 45%. Also, listings are increasing and time on market is creeping up. In the city of Los Angeles, homes were averaging approximately 56 days to sell in August 2025, up slightly from prior years. When supply increases and demand softens, it increases the risk of downward pressure on prices, or at least slower growth. Some of the gains in recent years in Los Angeles stem from ultra-premium locations and lifestyle appeal, beach city entertainment. But now remote work trends and changing living preferences may soften the premium paid for location. If the willingness to pay a large premium for high-cost coastal urban homes declines, then markets like Los Angeles may see more flattening or correction. The California Affordability Tracker underscores that housing cost growth has far exceeded wage growth. For instance, between January 2020 and June 2025, monthly payments for a mid-tier home rose approximately 82%, while wages rose 23%. In Los Angeles, this gap means buyer purchasing power is stretched, which constrains the effective demand at high price levels. What this implies for 2025? Given the combination of high base valuations, affordability stress, rising inventory, and softening demand, the Los Angeles market is arguably at elevated risk of price correction or plateau in 2025. That doesn't mean a dramatic crash akin to 2008 is likely. The fundamentals, economy, population, desirability, remain reasonably sound. For example, if we assume median list price was about $1.2 million in August 2025, and year over year, it declined approximately 4%, as some data suggest, then median values could drift to the $1.15 million to $1.1 million M range if conditions continue. Indeed, one dataset lists a median listing price of approximately $995,000 for September 2025, though this may include broader housing types, which is considerably lower than earlier peaks. Santa Cruz. The coastal city of Santa Cruz has also shown signs of weakening market dynamics. According to reporting, across Santa Cruz County, the median home price in June 2025 was approximately $1.1 million, representing an 8.5% drop year over year. Inventory in the region hit a 6-year high, and homes were staying on the market for longer than 45 days in some neighborhoods. While the city itself may still have a slight year-over-year home price uptick, plus 1.2% as of June 2025 per one article, the broader county trend is downward. The mix of high valuations, premium location premiums being challenged, and higher supply all point toward increased risk of correction. For buyers, the shift is toward more negotiating power. For sellers, the formerly seller's market margins are shrinking. In Santa Cruz, 2025 may mark the transition to a more balanced, or even buyer-favored market. Thus, Santa Cruz is another California city where price pressure in 2025 is quite plausible. San Mateo. In high-cost Bay Area jurisdictions such as San Mateo County, the same market pressures apply: extremely high home prices, affordability constraints, and shifting demand dynamics. In earlier reporting, San Mateo was listed among cities in California that have experienced drops in home prices, alongside Palo Alto, Alameda, and Berkeley. The logic is clear. When valuations are very high, even a small drop in demand or uptick in supply can translate into significant downside risk. Buyers priced out elsewhere may exit the market. Existing homeowners may delay selling because of low legacy interest rates. Remote work options may reduce the location premium for dense urban/suburban nodes. In 2025, San Mateo is therefore well positioned as a likely site for price softness rather than strong growth. Palo Alto. The Palo Alto area remains one of the highest priced residential real estate markets in the U.S., and that very premium status is increasingly working as a headwind rather than a tailwind. The average home value in Palo Alto was approximately $3,453,771 as of September 30th, 2025, an increase of only approximately 0.6% over the prior year. A separate data set indicates that in June 2025, home prices in Palo Alto were down approximately 9.2% compared to a year earlier, though that appears to refer to a narrower subset of sales or perhaps contracted deals versus closed sales. Additional indicators show potential softening. In the Midtown Palo Alto neighborhood, median sale price in September 2025 was approximately $3.22 million, representing an approximately 8.0% year-on-year decline. Key structural facts. Inventory is low in absolute terms, e.g., Zillow lists 110 for sale inventory on September 30th, 2025. For a city of Palo Alto's stature, median sale to list ratio, meaning homes still on average sell just slightly above. Days to pending are approximately 16 days in the market on average. High median home prices, median list approximately $3.09 million in September 2025, means affordability barriers are steep. Why this matters and why it points to risk of correction. 1. Extreme valuations limit buyer pool. At approximately $3 million plus median price, many potential buyers are priced out or must take on high mortgages. That reduces demand elasticity. 2. Switch from rapid appreciation to stagnation. the very modest annual increase, 0.6%, implies that the extraordinary appreciation of earlier years has largely run its course, making Palo Alto more vulnerable if conditions worsen. 3. Neighborhood-level declines already evident. The Midtown figure down. Approximately 8% suggests some submarkets are beginning to show actual declines rather than just flat growth. 4. Macro structural headwinds. Factors such as high mortgage interest rates, remote work dislocations reducing premium for commuting into tech hubs, and overall affordability stress apply here. A commentary piece noted that some ultra-premium zip codes, including Palo Alto, experienced year-over-year declines of approximately 12.80% in one dataset. In short, while the headline numbers still show high values and modest gains, beneath the surface there are signs of easing momentum and price softness in certain segments. For 2025, Palo Alto is a high-risk city for a meaningful price correction, given its premium base, limited buyer pool, and shifting market dynamics. Palm Springs. Shifting to a different market context, Palm Springs in the Coachella Valley is less about tech jobs and coastal lifestyle and more about resort and second home demand. Yet, it too shows strain. The number of home sales in the 3-month period ended June fell, 135 sales versus 149 year prior. Inventory rose to 754 units, highest level in years, and homes stayed longer on the market, median 52 days versus 46 prior year. The average home value in Palm Springs was approximately $623,753 as of September 30th, 2025, down approximately 5.5% year over year. Other data reinforce the shift. In June 2025, inventory in the Coachella Valley stood at 3,608 active listings, up from 2,598 the prior year, a jump of over 38%. Homes in Palm Springs are remaining on the market longer. Median days on market increased to 52 from 46 in year-over-year comparison. For listing prices, Realtor.com reports that in April 2025, the median listing home price in Palm Springs was approximately $784,900, down approximately 5.3% year-over-year. In August 2025, the median listing price was $699,900, down approximately 6.7% year-over-year. Additional specifics: detached homes in the region averaged approximately $1,247,000, down approximately 3.1% in a recent period, while attached homes increased approximately 1.9% to $450,000. But those data apply to a prior reporting period. What this means: 1. Inventory surge signals buyers' market pressure, with listings rising approximately 38 to 40% YY and months of sales ratio climbing to approximately 5.5 months versus approximately 4.2 last year. The balance is shifting toward buyers. 2. Price declines and longer market time underline cooling. A drop in average home value, approximately 5.5%, and longer days on market highlight weakening demand. 3. Second home resort market particularly exposed. Palm Springs has heavy exposure to discretionary buyers, investors, and external demand, all more sensitive to economic/interest rate shifts. 4. Affordability started to bite and seller expectations lag. Price reductions and homes selling below list. Average discount approximately 4.1% versus approximately 3.1% prior year indicate that some sellers are coming down from earlier high pricing expectations. Unlike ultra-premium metro markets, Palm Springs may have more room to correct because values were lower to start with and inventory is expanding quite rapidly. For 2025, it is firmly among the cities where price softness is not just possible, but actively likely. In summary, the California housing market is shifting from a fast-rising environment to one of moderation. And for many of the highest-priced cities, the shift may mean outright price declines rather than just slower growth. High valuations, rising inventory, affordability constraints, and changing buyer behavior are creating stronger headwinds. For coastal and premium metro markets, while none of the data suggests a catastrophic crash of the magnitude seen in 2008 is imminent, analysts agree the fundamentals are still stronger and supply constraints remain in place. The risk of meaningful correction in 2025 is real. For buyers, this environment may bring more negotiating power, longer time on market, and potential value opportunities. For sellers, the era of quick, steep home price gains appears to be receding. Pricing discipline and realistic expectations will be more important than ever in 2025.